Good morning, students. In previous class, we have studied about the topic profit and loss appropriation account, in which we have made a segregation between charge items and appropriation of items. And after studying the topic, we have concluded that all appropriation items will read under profit and loss appropriation account. And moving forward, financial statements or final accounts of partnerships are prepared at the end of every financial year. In 11th class, you all have studied about the preparation of final accounts, in which you prepare trading account, profit and loss account, and balance sheet of sole proprietor. And on the same way, the final accounts of partnerships are also prepared, but there is slightly some accounts differs. For example, uh, while we preparing final accounts of partnership firm, we have to prepare some more accounts. As here is, there are following accounts which are prepared in case of partnership account, and these accounts are partners capital account. Second is how we will deal with the remuneration given to partners, whether salary or commission or anything else. Then, if deed is allowed, the interest on partner's capital, and if deed allows, interest on partner's drawing. And special thing is about is this, that is, in summary, it is known as past adjustments. It means any error if committed, how we will deal with this situation. And last topic is guarantee of profit. So in today's class we will do or cover the topic partners capital account and remuneration. As far as partners capital account are concerned, a partnership firm has more than one owner, because basic feature is more than two persons do the partnership business, and capital accounts are maintained for each partner separately. Where in case of sole proprietor, you prepare only a single account. You need not to prepare different accounts of capital. But here there are more partners, so we have to prepare more accounts of capital. It means, so because each partner have separate transaction with the firm, that's why we prepare partners capital account for all the partners. In order to maintain partners capital account, we have two methods of recording partners capital account. One is fixed capital account method and other is fluctuating capital accounts method. We will do first fluctuating capital account method. If we talk about fluctuating capital account method, in this method all the transactions of a partner, for example, withdrawal of capital or introduction of capital, salary, commission allowed, interest allowed on capital, drawing against profit, interest charge on drawing, share of profit or loss, are transferred to his or her capital account. As a result, balance in the capital account fluctuates with every transactions. Here, the balance of capital account fluctuates with every transactions. Capital account having credit balance are shown in the liability side. As we know, if we have a credit balance in capital account, it will be shown in the liability side. And while capital accounts having debit balance are shown under asset side of balance sheet. Let's have an example of fluctuating capital account. Under fluctuating capital accounts, we prepare in partnership, we mostly prepare combined accounts, like here partners capital account, partner X, Y and Z debit side and XYZ on credit side. You may prepare separate accounts for X, for Y and for Z, but in summary we can also do partners capital account in this way. This is the method of doing or preparing capital accounts in fluctuation method. While we are preparing capital accounts in fluctuation method, here is we start balance brought down on credit side, and all the items or income which is given to partner will be credited, and anything which we have to take from partner will be debited. Normally it have a credit balance, so balance brought down in case of credit balance. If any partner have debit balance, then it will start from here, balance brought down in case of debit. After that, whatever the partner gets, if a partner introduce further capital to the firm, it will be credited in his capital account by cash or bank account. If partners get interest on capital, it will be credited. Commission credited, partner's salary, and share of profit in profit and loss account, all will be credited. In the same way, if partners withdraw the capital then or drawing against capital, it will be to bank or by bank. Then two drawings, it is known as drawing against profit. We will discuss in detail in next topic about these drawings of capital and drawings against profit. Just here we have to learn only is that in first entry partner have withdrawn their capital, whereas in second one partner have not withdrawn their capital. It is known as normal drawing, irregular drawing. Next, interest on drawing. If partnership withdraws and we have charged any interest on drawing, and share of loss as per P&L account. Whatever the balance remains will be here balance carried down of each partner, and it will be shown under liability side. If some partners have balance on credit side, then it will be shown on asset side. This is the way how we prepare partners capital account under fluctuating capital account method, in which each and every transaction is passed under accounts, capital accounts of partner, due to which with each entry the accounts fluctuates. That's why we can say it is a fluctuating account method. Now move to next one, that is your fixed capital account method. Under fixed capital account method, the capital invested by each partner in the firm remains fixed and unaltered unless it is unaltered or fixed unless when a partner introduces additional capital or withdrawal out of his or her capital. It means in this case capital account changes only when either there is reduction of capital or there is any withdrawal of capital, otherwise there will be no change in capital account. Let's understand this with an format. Here's the format: partners capital account starting with balance brought down of each partner, balance brought down with each partner, balance of X, balance of Y, and balance of Z. If any partner introduces the capital, then by cash, entry will be bank or cash account debit to concerned partner's capital account. When it is posted in capital account, it will be by cash or bank additional capital introduced by the partner. Then if any partner withdraws the capital, then it will be to bank or cash drawing against capital, and it will be deducted from their account by debiting the amount, and resulting will be balance carried down. These are only four items which will be dealt under partners capital account while we are preparing fixed capital account method, and all the entry except these will be done under partners current account. I think it is clear to all that in partners capital account under fixed capital method, we will do only two entries, either addition of capital or withdrawal of capital. All the entries will be dealt under partners current account. Or when we prepare partners capital account under fixed capital account method, then we have to prepare two accounts. One is partners capital account, another is partners current account. Partners account, current account start with balance brought down if they have credit balance, and balance brought down if they have debit balance, and all the entries except addition and withdrawal of capital will be done under partner's current account. As example, by interest on capital given to partner, commission given to partner, partner's salary given to partner, and any share of profit given under profit and loss account. Thereafter, on debit side, any drawing made against profit, interest on drawing, and share of loss under profit and loss account. And this is the balance carried down of partner X, partner Y, and partner Z. If any partner have carried down balance on the credit side here, then it will be transferred to asset side, and normally if balance carried down on debit side of this account, it will be shown under capital on under liability side of balance sheet. I think the difference between these two have been clear to all. Now take an example by which we do practical question so that we clarify the topic. Here's a summary flowchart about the under fixed account system. We have to prepare two accounts, capital and current, and with two entries it will be debited, how it will be credited, and in under current account what is debited and what is credited. Under fluctuating system, you are preparing only one account, that is capital account, and what are credited and what are debited. What we have studied under the formats. Now is the difference between fluctuating capital and fixed capital. You can do. There is no more big difference or any conceptual more tough are there. Then capital account and current account, the difference between these two. Now we move toward a question in which a question is done with both methods so we can understand the difference. Here's the question. I am reading the question. There is illustration 13. A and B are partner with their capital 60,000 and 20,000 respectively on 1st April 2019. Net profit before giving effect of partnership deed for the year ended 31st March 20 was 24,000. It means anything which is given in partnership deed has not been given to the partner. Before that, the profit is 24,000. As per partnership deed, B, the partner, will get a salary of 6,000 per annum. Interest on capital is allowed at the rate of 6%. Interest on drawing is charged at the rate of 5%. Then, drawing of partner A and B are 6,000 and 4,000 respectively. And interest on drawing of A is 200 and of B is 100. Show how profit is distributed among A and B, and also prepare capital account of partners with their drawing account if capital accounts are fixed and if capital accounts are fluctuating. First of all, we have to divide the profit among the partner, which is done under profit and loss appropriation account. So first we will see how profit and loss appropriation account is prepared in this question. Here is the net profit and loss account is here 24,000. Thereafter, interest on drawing on credit side, that is 200 and 100, total is 300. Thereafter, interest on capital, which is allowed at the 6%, is 3600 and 1200. Then salary given to B 6,000. Whatever is the remaining balance will be divided among the partner equally. And here, when we are dividing the profit, we have written A's capital account oblique current account, B's capital account oblique current account. This is written because if we are preparing capital accounts as per fluctuating method, then A's capital account will be only there. And if we are preparing under fixed method, then it will be A's current account, because introduction and withdrawal of capital is only deal under capital account in case of fixed accounting system. So after preparing the P&L account, let's go to the capital accounts. If we are preparing under fixed capital method, then balance brought down is 60,000. In the question, neither there is any withdrawal of capital, neither there is any introduction of capital. So balance brought down is 60,000 and carried down is also 60,000 on the last date. Same in case of B, balance brought down 20,000 and on the last date balance carried down is also 20,000. Now moves to current account, because under fixed capital account system we have to prepare two accounts. uh, except from capital account we also have to prepare current account. A's current account, there is no opening balance given in the question, so on the last date by interest and capital given to partner is 3600, share of profit and loss appropriation account then 6750, A's drawing is 6000, interest on drawing 1000, and balance carried down after all is 4150. This will appear on the liability side of balance sheet. Same with the B, final balance carried down will be shown under liability side. This is how we prepare profit and loss appropriation account and prepare capital and current account in case of fixed capital account system. If we are preparing, suppose if we are preparing, as per given in the question, if we are preparing accounts on the fluctuating basis, capital account on fluctuating basis, then under fluctuating system A's capital account will be like this: opening balance 60,000, whatever the partner received from the firm, interest on capital, credit side, profit share on credit side. On the debit side, drawing of partner A, interest on drawing of partner A, and balance is balance carried down 64150, which will be shown under liability side of balance sheet. This is the way how we prepare capital accounts under fluctuating capital account system. And same with the B's capital account, same entries are there. So I hope it is clear to all the students how we prepare capital account under fixed system and fluctuating capital account system. Now we will move further. That is, next topic is remuneration or salary or commission to a partner. It means how entry regarding remuneration, that is salary or commission, will be given to partner. As we all know, salary or commission to a partner will be given only to partner if it is allowed under partnership deed, and if partnership deed is silent, then no commission, no salary will be given to any partner. And suppose if partnership deed has allowed it, then salary and commission to a partner is appropriation. It will always be appropriation, and it is not a charge item. And since it is not a charge item, so all the remuneration, salary and commission will be shown under P&L appropriation account, as we have studied in our previous class. Here only thing is that sometime a statement says कि the partner will receive some percentage, suppose an example of 10%, 10% of net profit, that is divisible profit. Divisible profit, I have explained in previous classes. Divisible profit before charging such commission. It means they are saying that whatever will be the divisible profit, that is here divisible profit or net profits as per the statement of the question, before commission, this is the profit, and you have to take some percentage, that is 10%. So divisible profit or net profit as per the question, then 10 by 100 will be the amount will be given to partner. But suppose take an example of 15% in second point, 15% of net profit or divisible profit, whatever the question says, 15% of net profit or divisible profit after charging such commission. It means the question is saying you have to deduct this commission and then compute the share. So in that case, take net profit or divisible profit as per the question, uh, into, if rate is 15%, it will be 15 divided by 100 plus 15, that is 15 by 115. By this you can compute the net profit or divisible net profit share or divisible profit share after charging such commission. So I think it is clear if it is given before charging commission or after charging commission. For computing after charging commission, we have to do a single decimal, that is if rate is 15%, then 15 divided by 150. but if it is before charging, then 10 by 100. As far as it is concerned about accounting treatment, so entry will be when we give remuneration to partners, whether it is salary or commission, it will be partners salaries or commission account debit to partners current account or capital account, depending upon the question. If it is fixed, capital are fixed, then it will be partners current account, and if capitals are fluctuating, then it will be partners capital account. And this salary and commission, we will write off it through P&L appropriation account. So under P&L appropriation account, on the debit side, to partner's salary or commission, this will be the entry regarding treatment of remuneration, that is salaries or commission to a partner. Let's take a question. We have we have done the question of P&L appropriation. Instead of that, taking a question so that this topic is clear to all. XYZ a partner in a firm. X is to get a commission of 10% of net profit before charging any commission. Y is to get 10% of net profit after charging all commissions. Net profit for the year is 55,000 and we have to divide this amount. And now here we have to study for X. It is said 10% of net profit before charging any commission. So under account, net profit is 55,000 under P&L appropriation account. X commission 10% of 55,000 will be 5500 and final. In case of Y, it is saying Y is to get a commission of 10% of net profit after charging all commissions. All commissions mean commission of X and commission of Y both. So first of all, out of 55,000, I will reduce it by 5500 as it is given to X. The resulting figure is 49,500 into 10 by 110, not 10 by 100, because it is saying after charging all commission. So after reducing this, the whatever will be the amount into 10 by 110, we will get the amount 4500. This will be a commission of Y, because in this question it has been said that after charging all the commissions, for all the commissions out of net profit, first we will deduct the commission of X 5500. The resultant figure includes the commission of Y. So after charging commission, we will do 10 divided by 100 plus 10, that is 10 by 110, and resultant will be the amount of commission given to Y, and the resultant or the remaining figure will be divided among the partners as profit. This is the way how we will give the profit or commission to partner after charging the commission or before charging such commission. In the next class, we will take the topic interest on partners capital and interest on drawing. Thank you.